In February 2022, AT&T told its shareholders that the dividend they had been collecting faithfully for decades was about to be cut nearly in half. And within 2 days, the stock had fallen 7%. But then something happened to the one number those shareholders trusted most, and it makes no sense at all until you understand what a dividend really is. On paper, the dividend yield went up from roughly 6.5% to more than 7%. The company was paying out less money, the shares were worth less money, and the single number that millions of people used to choose income stocks looked better after the disaster than it had the week before it. That number lied to them. And if you invest for dividends, there is a decent chance it is lying to you right now. Before we go further, this is education, not financial advice. I am not telling you what to buy or what to sell. I am going to show you what the numbers say, and then you can decide what to do about them. Here is the story you have been sold, and I want to be fair to it, because it is genuinely appealing. You buy shares in solid companies, those companies send you cash every 3 months, and you live off that cash while your shares quietly keep their value in the background. Income without ever selling anything. Free money, forever. You have seen the screenshots. Somebody posts their dividend income for the month, €11 in January, 40 by the summer, 100 by December, and the comments fill up with people cheering them on. Nobody in that thread ever asks the only question that matters: what happened to the share price while those payments were landing? I am not mocking those people, because the discipline behind dividend investing is real and it genuinely works. People who chase dividends tend to save more, invest every single month, and stay invested through the ugly years, and those habits build serious wealth over time. But the habits deserve the credit here, not the dividend. The core idea is still a myth, and researchers have measured what it costs inside real portfolios, somewhere between 2 and 4% every single year. So what actually is a dividend? A company you partly own has cash in its accounts, and it decides to send some of that cash to you, which feels like income, in the same way that rent from a tenant feels like income. But here is the mechanical truth, and this is not a theory or an opinion. On the day a stock pays its dividend, the share price drops by roughly the amount of that payment, because the exchanges adjust the price on the morning it is paid. Picture it with round numbers. Your share is worth €100, the company pays you €3, and the next morning your share is worth about 97, which means you hold €97 of stock, plus €3 of cash, adding up to exactly the 100 you had yesterday. No new money appeared. Money moved out of one of your pockets and into the other one, and depending on where you live, the tax office takes a cut on the way across. Miller and Modigliani proved this logic back in 1961 in work that helped earn a Nobel Prize, and their conclusion was blunt: a dividend does not create value, it relocates value. Now the obvious objection, and you have probably already thought of it: my dividend stocks recover. The price fills back in over the following weeks, so the payment really was extra money on top of everything else. Look carefully at what actually happened there, because the sequence is what matters. The price recovered because the business earned new profits, and those profits were coming whether or not the company handed you a check. If the company had simply kept the cash, your shares would now be worth €3 more than they currently are. You were not paid extra. You were paid earlier and taxed earlier, and those are very different things. So why do intelligent, careful people keep falling for this? Because our brains are built too. In 2019, 2 finance professors named Samuel Hartzmark and David Solomon published a study in the Journal of Finance, and the title tells you almost everything you need to know: the Dividend Disconnect. They went through real trading records, and what they found was remarkable. Investors treat the dividend and the share price as 2 completely separate things inside their heads, spending the dividend like a salary while quietly ignoring the fact that the money came straight out of the price of the thing they own. The researchers gave that mistake a name. They called it the free dividends fallacy. And the mistake has a price tag attached to it. When demand for dividend stocks runs hot, which usually happens when interest rates are low and everybody is hunting for income, Those stocks get bid up beyond what the underlying businesses are actually worth. And in exactly those periods, the study measured returns 2 to 4% per year lower than comparable stocks. 2 to 4% every year. Compounded across 2 or 3 decades, that is not a small leak. And on a €50,000 portfolio held for 20 years, that gap can be the difference between a comfortable retirement and a nervous one. Stay with me, because the next part is where most dividend videos quietly stop. Even if you accept the trade-off, the deal itself has got worse. The S&P 500 currently yields about 1.1%, which is close to the lowest level in more than 100 years, while the historical median sits near 3%. So the income machine now produces 1.1%, which on €100,000 works out to roughly €90 a month, before tax. You cannot retire on that. And here is the part that almost nobody mentions. The companies themselves have already moved on. In the third quarter of 2025, the companies of the S&P 500 spent $168 billion on dividends. And in that same quarter, they spent $249 billion buying back their own shares, with full-year buybacks heading toward a record of roughly $1 trillion. A buyback returns cash to owners too. It just does it quietly, by shrinking the number of shares so that every remaining share owns a bigger slice of the company, and no tax form lands in your mailbox. Corporate America walked through that door years ago, while a lot of ordinary investors are still queuing at the expensive one. Which brings us back to AT&T, because the trap has a very specific shape. For years, AT&T was the classic income stock, the one people called safe without ever checking why, with 36 straight years of dividend increases behind it. As the yield climbed from 6% to 6.5% to 7%, income investors kept buying more of it. While they were buying, the company was borrowing tens of billions of dollars to build a media empire, first DirecTV and then Time Warner. The debt grew, the core business did not. And because the payments kept arriving on schedule every quarter, everything continued to look completely fine. But ask the uncomfortable question that almost nobody was asking at the time. Why was the yield so high in the first place? A yield is only the payment divided by the price, which means there are exactly 2 ways for it to rise. The company pays out more, or the share price falls. AT&T's yield was not high because the company was generous. It was high because the market was quietly pricing in a mountain of debt and a media adventure that was not working, and as the price sank, the yield rose, and that rising yield pulled in exactly the investors who were least prepared for what was coming. In February 2022, the dividend was cut from $2.08 to $1.11, a reduction of 47%. The safe income was gone, and the share price had already been falling for years before the announcement ever arrived. That is the yield trap. A very high yield is not a gift from a generous company. It is very often a warning, written in a language that most buyers refuse to read. There is one more cost, and it is the quiet one that never appears in the screenshots. Every dividend is a taxable event in the year it lands, whether or not you needed the cash. In the United States, qualified dividends are taxed at up to 20%, plus surcharges for higher earners, and in Germany, roughly 26.5% comes off the top every single year, automatically. Capital gains work in a fundamentally different way. You choose when to sell, which means you choose when the tax is due, and until that moment arrives, every euro of your gain keeps compounding for you instead of for the government. A dividend takes that choice away completely. It is a forced tax bill, arriving on somebody else's schedule. Same wealth, different timing, and, across 30 years, timing is money. Run the numbers once. 2 investors, each starting with €100,000 and earning 7% a year for 30 years, where the first pays tax once at the end, and the second takes everything as taxable dividends, loses a quarter of each payment, and reinvests the rest. The first ends up with roughly a fifth more money from the same market and the same risk, purely because of when the tax office got paid. Now, before you sell everything and go and shout at your favorite dividend channel, here is the other side, because the honest version of this argument has one. Dividends are not the enemy. Since 1926, roughly 31% of the total return of the S&P 500 has come from dividends, and in some decades, like the 1940s and the 1970s, it was more than half of everything investors earned. Anyone telling you that dividends do not matter is selling you a different myth. But read that sentence carefully, because everything depends on a single word. That 31% came from dividends that were reinvested, put straight back into more shares, which then paid more dividends, which bought more shares again. It did not come from treating the dividend as a monthly salary. The moment you spend the payment, you step out of the exact engine that made dividend investors wealthy in the first place. The classic dividend names also have real virtues because they tend to be stable, profitable, boring businesses that fall less than the market in a serious crash, and they held up noticeably well in both 2008 and 2022. There is even a psychological defense of dividends, and it is the strongest argument on that side. That cash landing in your account makes you feel paid, and feeling paid is what stops a lot of people from panic selling at the bottom of a crash. If a dividend portfolio is the only thing standing between you and the sell button in March 2020, keep it. Just be honest about what you're buying, because you are buying behavioral insurance, and the premium is 2 to 4% a year. So what do you actually do with all of this? First, change the number you optimize for. Stop asking what a stock yields and start asking what it returns, because total return, which is price growth plus payments after costs and after tax, is the only number your future self can genuinely spend. Second, if you really do need income, build it yourself, because selling a small slice of your shares creates exactly the same cash in your hand, except that you choose the amount, the month, and when the tax is due. The mathematics is identical. The control is not. Third, treat every unusually high yield as a question rather than an answer, and ask what the market might know that you do not. Sometimes the answer is nothing. With AT&T, the answer was everything. And fourth, if you love your dividend stocks, keep them, but reinvest while you are still building. Understand what the tax is costing you, and never buy a company simply because the yield looked attractive on a screener. Here is the whole argument in one line. A dividend is not income that the market pays you. It is your own money, handed back to you, with a tax form attached. The companies worked this out years ago. The professors proved it, and the AT&T shareholders lived through it. Now you know it too, which puts you a long way ahead of a very large and very confident crowd. If this changed how you think about your portfolio, subscribe, because next time we take apart another comfortable belief the finance industry would rather you kept believing. And tell me below, are you team dividends or team total return? I read the comments, all of them.